Hey everybody, it's hwsteele, and today is April 20th, 2021, which makes this the third weekly video for the month of April. In this video, I want to talk to you about a relatively well-known concept in the technical analysis community for trading stocks, commodities, forex markets, so forth and so on. And that concept is old resistance becoming new support, or old support becoming new resistance. Kind of the opposite sides of the same coin, so to speak. And it's a pretty well-known phenomenon. It's not exactly some mysterious thing, but an example of it, well, I'm going to show you here on the Euro-US dollar chart. This is a 4-hour chart that I'm using as the example. And this is just the most recent market data of the chart, last couple of months or so. And a good example of it would be right here, where we have a top, the market moves down, makes a bottom right here. The market moves up, moves through that price level down here to a lower bottom, and then it retraces back up and it stops at the same point that this bottom was at as far as price is concerned, right here. And this is a absolutely classic example of old support becoming new resistance. And that's typically what we're looking at here. What we look for when looking for this is we see a support or resistance level. Then the market moves through that level in the direction of whatever it is. In other words, this is support, so it retraces off of that, then moves down, since we were talking about support, and continues down further, but then it retraces, and it retraces back up to the point where that support was right there. Pretty simple concept, right? Nothing, super duper cool about that. Actually, that's not true. It's a really cool phenomenon if you think about it, and is actually very helpful in trading if it's something that you pay attention to. Or I should say, it can be very helpful in trading. So one thing that I do when I look at support and resistance in this way is look at the amount of time it takes to do the retest of that price level. So I'll go ahead and draw a horizontal line right here at this support level, and then the market moves, comes down here, and then comes retracing back up, stops right smack on that level. I mean, that's an absolutely beautiful example of old support becoming new resistance. And then I will measure this amount of time right here, which is 45 bars, and then just double it among other things. But I always start with the doubling of, so I look for 90 bars, which shows up right here. And right about this point in time, we have an acceleration of the trend. In other words, we have a larger trend than what was going on. We were in a trading range right here, and then we broke out right about there. And then we just kind of broke out and made the next stair step down, so to speak, before we retraced back up, which eventually we just continued retracing up even higher than this point right here. But another example of this is we have a move up here, makes a top. This is a much smaller move, makes a top right here, retraces down, it goes right through it in the same direction. So we get resistance here, retracement, breaks through that resistance, comes up, we see the resistance here, which was in step with this support right there. But then we come down and we make support right here, which is again old resistance right there. So this time we have like 3 candles coming down on it right here. So we would just pick the middle one to start with. We have this point right here, so that's where we would start our count and just kind of go to the middle candle right there, which is 18 bars. Then we would double it to our 36. We come up right here, and then we get an acceleration in the direction of the market, and it breaks out to a new high. Obviously, in regards to this top right here, it's just hitting the same level, but we've been getting lower tops right there, and this acceleration of the market right there broke above this and this before it finally stopped right there. And again, this is a much smaller reaction that we're measuring here than this initial one that we got right here. So these are examples of really good, we have support here that's almost precisely exactly that resistance there, and then a resistance here that's almost exactly precisely the support here. So that's pretty good. They're really crisp examples, I guess we could say. But then we have things like this right here. We have a move down, we get a bottom right here, support. We move back up a small retracement, then we break down past this right here. And then we have a retracement up right there, which touches that line exactly right there. And then we come down from there. So we can measure right there. We have our closest example right there. I would start with this one because it's the absolute lows on these two candles are pretty much the same, but this one has a lowest close, so I would start with this. And then we go right here. We find that it's 23 bars, so doubling that would be 46. 45, 46 right here gives us this acceleration in the trend, where the trend continues up and breaks higher than it was. And technically it doesn't break to a new high because we had this clean, smooth move right here, but it did accelerate past, and the amount that it moved past this top versus this top is greater. In other words, the number of pips from this top to this top, or from this top to this top, was exceeded by this acceleration that was timed by doubling this length right there. So let's see if we can find some other examples of it in the move up here. This one is not quite as clean right here. See that? We have, let me mark that right there. We have a top right there, so we have resistance. The market comes down, retraces, breaks through that, and then it comes down, and it doesn't quite touch it right there. So let's see what kind of reaction we get. Now when measuring this, these two are pretty much the same high right there, the absolute price of those two candles, but the highest close is right here, so that's what I would start with. And then we just move to right here, and we have 12 bars, so double that of course is 24. And even though we're right here, we get an acceleration to the upside that's a little less exciting. I mean, it's not as great as what came before it, but we didn't have as precise support becoming the resistance right there. So this is just something that I wanted to show to you that I actually use, I look at from time to time, and it's very helpful. The support becoming resistance and resistance becoming support in and of itself is helpful, but the timing element helps out. And not every market's going to be a one-to-one. Not every time frame is going to be a one-to-one. You might do some testing on this if this is something that you're interested in. And you might find that a 1.5 to 1 or a 2 to 1 ratio is what works best in your particular market. So in other words, if you measure from old support to new resistance, or old resistance to new support, you measure, let's say, 10 bars or candles, and then instead of doubling that to 20, you might triple it to 30, which would be a 2 to 1 ratio, and so forth and so on. And I'm pretty sure that by this point you are understanding the concept quite well. So hopefully this has been helpful to you in some form or fashion, something to experiment with and play around with if you find it interesting. And I will talk to you next week in the next video, which, let's see, that's the 4th week for the month of April, the last video for April, which makes that the Gann week video. So talk to you then.